One of the most common questions people ask when they start investing, and even years into their investing journey, is this: should I invest into ETFs or individual stocks? You hear strong opinions on both sides. Some people say ETFs are boring and you'll never get rich that way. Others say picking individual stocks is basically gambling. In this video, we're going to break that down. What ETFs and individual stocks really are, the risks and rewards for each, what the data says about long-term performance, and most importantly, which option is best for most people. Not what sounds exciting, not what works for professional people, but what works for regular people trying to build long-term wealth. By the end of this video, you'll have a clearer answer and actually a strategy to be able to stick to. Welcome back to the channel where business, money, and investing actually make sense. Before we get started, do me a quick favor, hit the like button and subscribe to the channel and turn on notifications. It really helps the channel grow and allows me to keep putting out clear, practical investing content like this out every week. All right, let's get into it. What are ETFs and individual stocks? Before we compare them, let's make sure we're on the same page. What is an ETF? An ETF is an exchange-traded fund. An ETF is a single investment that holds many different assets. Usually it's stocks, but sometimes it's bonds and other securities. You can think as an ETF as a pre-built portfolio. For example, an S&P 500 ETF owns shares in 500 of the largest US companies. A total market ETF owns thousands of companies. A sector ETF may only hold technology, healthcare, or energy stocks. ETFs trade on the stock market just like individual stocks, but instead of betting on one company, you're investing into an entire group at once. Now, what is an individual stock? An individual stock represents ownership in one company. If you buy Apple stock, you own a small piece of Apple, and if you own a Tesla stock, you own a small piece of Tesla. Your returns depend entirely on how that company performs, its earnings, its leadership, competition, and future growth. Here's a key difference and a simple way to think about it. With ETFs, you have diversification in a single purchase. With stocks, you have concentrated bets on individual companies. Let's talk about risks and diversification, because this is where stocks and ETFs truly separate. Why does diversification matter? Diversification means spreading your money across many different investments, so one failure doesn't ruin everything. If you own one stock and something goes wrong with that company, your portfolio can take a massive hit. If you own hundreds of companies through an ETF, a single failure barely moves the needle. This is one of the most important concepts of investing, and it's backed by decades of research. Let's go over ETFs and risk reduction. ETFs dramatically reduce company-specific risk. If one company misses on its earnings, loses market share, faces regulation, or even goes bankrupt, the rest of the ETF continues to function. That doesn't mean ETFs are risk-free. Market downturns still happen, but they remove risk of betting everything on a single company. Now let's go over individual stocks and concentration risks. Individual stocks are inherently more volatile. A single earnings report, a lawsuit, a CEO change, or a headline can move a stock 20 to 30% in either direction. That volatility creates opportunity, but it also creates danger, especially for investors who don't have the time or emotional discipline to manage it. Now let's go over cost, fees, and tax efficiency. Another major difference between an ETF and a stock comes down to cost. ETF costs. Most broad market ETFs have very low expense ratios, often between 0.03% and 0.1% per year. That means for every $10,000 you have invested, you might pay $3 or $10 annually for it. These fees are automatically deducted and barely noticeable, but over decades, low fees matter. Now let's go over individual stock costs. Buying a stock doesn't come with an expense ratio, but costs still exist. Frequent trading can create tax consequences. Short-term capital gains are taxed at higher rates. And emotional trading often leads to buying high and selling low. Most investors underestimate how much behavioral costs hurt them in the long run. Now let's go over tax efficiency. ETFs are generally more tax efficient than active stock trading because they trade less internally, they generate fewer taxable events, and long-term ETF investing minimizes capital gain taxes. For investors in taxable accounts, this is a meaningful advantage. Let's take a look at the returns. Can stocks really beat ETFs? This is a part everyone cares about. Yes, individual stocks can outperform ETFs. Some companies deliver extraordinary returns over long periods. If you bought the right stock at the right time and held, you could outperform the market. But here's the uncomfortable truth. Most stocks do not beat the market. Academic research consistently shows that a small percentage of stocks generate the majority of market returns, and most individual stocks underperform the broader market over time. Even professional fund managers with teams of analysts fail to consistently beat index funds. That's not an opinion, that is data. Here's what ETFs aim to do. ETFs don't try to beat the market, they try to capture the market's return. Historically, broad US market returns average about 7 to 10% annually over the long term after inflation. That may not sound exciting, but compounded over decades is incredibly powerful. Now let's go over psychology and investor behavior. One of the most overlooked differences between stocks and ETFs is human behavior. Here's why most people lose money while stock picking. Most investors don't lose because of bad math, they lose because of bad decisions. They panic sell at market downturns, they chase hype at market tops, they overtrade, and they let emotions override logic. This is how ETFs help behaviorally. ETFs encourage long-term thinking, less trading, and more consistency with less emotional stress. For most people, behavioral discipline matters more than strategy selection. A simple strategy you stick to beats a complex one that you abandon. Let's go over ETF misconceptions and real risks. Let's clear things up. ETFs are not perfect, and they are not risk-free. If the market drops 30%, your ETF will also drop too. Diversification protects you from individual company failures, but not from market cycles. Not all ETFs are diversified. Some ETFs are highly concentrated. There's sector ETFs, there's thematic ETFs, and there's levered ETFs. These can behave similarly to individual stocks, sometimes even riskier. Always understand what's inside an ETF. Now let's go over who should choose ETFs. ETFs are ideal if you are a beginner, want long-term growth, you don't want to research companies constantly, you want a diversification automatically, and prefer simplicity. This is why ETFs are widely recommended by financial planners, retirement experts, and academic researchers. For most people, ETFs form an excellent core portfolio. Now, who should invest in individual stocks? Individual stocks make sense if you enjoy analyzing businesses, you understand financial statements, you can tolerate volatility, and you have the discipline to hold long term. Stock picking is not wrong, it's just hard, and it requires skill, patience, and emotional control. Now there's a smart compromise, which is a blended approach. For many investors, the best answer isn't ETFs or stocks, it's both. Here's a common approach: 70 through 90% in diversified ETFs and 10 to 30% in individual stocks. This gives you stability and diversification, some upside potential, and less stress and regret. You're not betting your future on one idea, you're building resilience. Here's a couple of common investing mistakes to avoid: trying to time the market, chasing hot tips, over trading, ignoring taxes and fees, and taking more risk than you can emotionally handle. These mistakes matter more than whether you choose an ETF or a stock. All right, let's wrap this up. ETFs offer diversification, simplicity, and consistency. Individual stocks offer higher potential, but there's higher risks. Most people are better served with ETFs as their foundation, and a blended approach works well for most investors. Wealth building is not about excitement, it's about consistency over time. If this video helped you, make sure you like, subscribe, and share with someone who's trying to figure out investing. Drop a comment below. Are you investing in ETFs, individual stocks, or both? I'll see you in the next one.